transition of energy to more renewables is likely a trend that's going to continue. I've heard merits on both sides, but I think oil demand is still there, and it's going to be a while before we could ever transition fully away from that.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
How's it going, everyone? Welcome to another episode on Wealth Strategy Secrets. We've got a great show for you guys today. Today, what we are going to do is actually talk about some market updates. And we have joining us Jason Nees from Pantheon, who is going to help give us kind of a breakdown of current market dynamics, where we're seeing some opportunities, where we're seeing some risks, and really kind of, drill into that so you can make some better decisions about allocating capital this quarter. So welcome to the show, Jason.
Awesome. Thanks for inviting me back again.
Yeah, you bet. Always great to talk. And, hopefully this is going to be, shed some light. So many dynamics kind of going on, moving parts in the economy. It always seems like just so much uncertainty. And what I always love to do, as an investor is just, really try to weed through, what is the noise? Where can we create certainty? So we can start making, better decisions, right, with the information that we have. And then also try to decipher where there could be certain market opportunities, given certain fluctuation. But why don't we start the conversation off and kind of giving us a little bit of, your macro assessment of the economy at this point in time?
Yeah, I think, if you're looking around, the economy has been exceptionally resilient. If you would have asked at the beginning of the year, the consensus being that we would walk into a recession was generally kind of the commentators' outlook. They've been calling for that for a year and a half. Hasn't happened. We've been exceptionally resilient. There are a couple worrying things in there about the consumer from the standpoint of just looking at the overall market. The market itself, just looking at the stock market, NASDAQ and S&P have been kind of leading the charge. Last year, we talked a lot about the Magnificent Seven, or the top 7 stocks that kind of made the market go up. And this year, it's kind of worked in opposite. There's really 3 stocks that are working, which is Microsoft, NVIDIA, and Apple. What is a little bit unique and kind of what I look to the stock market as a barometer for is getting a bigger picture view of how things are moving around through the economy. And if you looked at kind of the top 3 things, what's actually working, you find technologies up 18%, communications up 16%, utilities, unsurprisingly, up 11%. But when you flip that around and say, okay, well, what's really not working, and what are the leading indicators kind of pricing us out of? Consumer discretionary is the second worst sector this year, kind of impending and kind of sensible when you think about inflation and some of the impacts it's had on household budgets. And real estate. We knew kind of coming into the year that there were some soft spots within real estate, both personal and commercial. And that being the worst sector this year is probably not that big of a surprise, but there are pockets of strength and pockets of weakness within that.
Yeah, for sure. And then what do you think? I mean, I think the elephant in the room, right, is really the upcoming, political outlook in the election year and, any kind of big points, you can see, whether the Democrats win or the Republicans win, any particular sways that you would anticipate?
Obviously, looking at the polling data, it's obviously a tight race. But I think from the standpoint of what to expect, I would say the status quo of more stimulus spending, more deficit spending, regardless of the candidate that is elected. I think if the Republican candidate is elected, then I think it probably makes more sense to see a rollback of some of Biden's policies, if not outright tax cuts and or increased deficit spending. And both of these presidents during their terms have done an enormous amount of deficit spending. So I expect that to be kind of status quo from either candidate.
Yeah, I know we just had a tax advisor in our mastermind group this week, and it was pretty illuminating to learn about some of the things that are proposed, really on the Democratic side in terms of, basically implications that could happen, whether bonus depreciation, continues to stay as an advantage for us, as a real estate investor, other additional, taxes or things that could be coming up. Did you have any thoughts or conclusions on that either way?
Candidly, no. I wish I had a better answer for you, but it's one of those things that I follow only because it's of interest to all of us. But I don't follow close enough to really know what their policies are going to be. I've seen what they proposed, but it's really hard to say when you're talking about just a candidate, but then you have to talk about a House and a Congress and what they might do. And I guess the best conclusion I would say is I would expect more of the same in a similarly dysfunctional Congress.
Yeah,
I wish I
yeah,
had a
for
happier
sure.
answer to that one.
Yeah, I mean, probably the 1031 exchange will be really interesting and of particular interest to many. And of course, we can't predict. And a lot of times they put these things, on the bills, but they never actually get passed or come to fruition. So, again, I like kind of weeding through that uncertainty and only working through the certainty. And in speaking with a lot of family offices and ultra high net worth investors myself, it's interesting how people are allocating capital because they're really looking past the elections, right? They're investing in a 10-year cycle or even more that's going to go through potentially two different parties, right? And see different things. So they're really trying to focus on those core fundamentals of the asset, versus that geopolitical risk.
Absolutely.
How about on the interest rate side? I mean, what are you thinking? What is your interpretation of how the Fed is currently paused? They've really changed their stance from I would say even 6 months ago. So let's talk about interest rates as well as where you see inflation heading.
Yeah, excellent question and good timing from the standpoint of the Fed just concluding their 2 day meeting yesterday. The kind of core takeaway from that is Jay Powell seemed to have a bit more of a dovish than a hawkish view, kind of signaling that they've made a lot of progress on inflation. Depending on your perspective, you may or may not agree with that. If you look at inflation data presented by the government, it's about 3.4% year over year. If you look at where interest rates are, I would expect to see probably one cut this year. Two is a possibility, but that's going to be in the latter part of the year, if anything. And there is kind of the inverse possibility that they do nothing at all if they start to see inflation creep up, in Q3 and Q4.
So are they feeling as if, I mean, if you're reading the tea leaves, where do they stand on inflation? Do they feel like they're kind of getting some things under control or?
Yeah, so if you read the Fed policy and kind of the dot plot as it's referred to, kind of it's kind of split 50-50 between the members saying that they've feel that they're at or near accomplishing their inflation target, and the other half feeling a bit more hawkish and feeling they need to either stand pat. I didn't see any that indicated an increase in rates, so that would be the outlier in this specific point. But I think the expectation is either 1 to 0 cuts for the remainder of the year.
Hmm. Interesting. And with respect to consumer spending, is that really aligned? Are you seeing those, data trends really aligning with what they are saying?
That's an interesting one, and one that I don't know that I have a clear cut answer to. If you listen to earnings calls from the Walmarts, the Targets, where people shop, you're seeing mixed trends. You're seeing their reporting as consumers spending down and trading down on certain discretionary options. But on the flip side, if you look at credit card data, credit card outstanding receivables are at an all-time high, with interest rates also being at an all-time high on that kind of variable product. So it's kind of a tale of two worlds, where you're seeing travel, entertainment, and kind of events are people are spending on those without any real hesitation. But when it comes down to durable goods, foods, packaged goods, things of that nature, you're starting to see people trade down. So it's kind of maybe it's an extension of the haves versus have-nots, but I don't know that there's a clear one-sided winner at this point. It's more kind of muddled noise, even though it may portend telling us something, but I candidly don't see what that trend looks like just yet.
Yeah. And what's your viewpoint on the stock market right now? Do you feel that it's overvalued? Which direction do you think we're headed for the rest of the year?
Boy, that's a tough one. Historically speaking, if you look at just kind of how a year typically progresses, if you have a strong Q1 in an election year, generally it means it ends that year higher, in an election year. But I think on the last update call we did, I was still at the point where I think that the stock market is overvalued. It is, in my opinion, still overvalued, but that does not mean that it won't go higher. It's concerning to see that the concentration of where the gains are coming from are from such a tight knit of companies is been repeated a thousand times. But that's continuously getting tighter. On the flip side, I think there are some options to be very selective. There are certainly pockets where the market is not overvalued, small caps being an example, but they're just not getting the same bid as large and mega caps where there's less competition.
Do you see any emerging trends kind of developing at this point?
Tech, AI, and anything on a company's call that does not reference AI are getting punished a little bit. But I would say that's the overall theme and trend for this year and probably next year, as you've seen there's a number of people with an opinion about NVIDIA, but if you look at their actual sales numbers, I mean, they're just crushing it right now from the standpoint of, selling their GPUs, selling their products. The AI spending boom is probably the biggest theme that's working within the market. I expect that will probably try to trickle down and flow through. You're seeing some of that flow through down to industrial and commercial real estate that needs more automation and AI within it. And so I expect, in 2025, we'd start to see some of that spending dollars flow through into the industrial and commercial real estate side as well.
Yeah, I had just attended the Global Energy Council meeting at the NASDAQ in New York a few weeks ago. And it was really fascinating to, hear from, the top thought leaders in the energy sector, analysts and everything on, some of the trends that are hitting them. And they were, speaking of AI, right, they're seeing AI as a massive bump in energy demand, that's really needed to be able to scale, right? I mean, we just don't have it right now, and that increase is going to put significant, load. So, so everyone was quite bullish on energy from that perspective.
Absolutely. And you've even seen it selectively. I believe, if I'm not mistaken, it was Amazon that just bought a data center campus, happened to be co-located with a nuclear reactor on site to try to solve the kind of power demands, but it certainly is going to flow through to oil and gas. And a lot of, I've seen, I guess, a lot of conversation about those data centers being retrofitted for natural gas as a energy source that's a little bit less expensive than oil or renewables.
Yeah. So let's talk about real estate a little bit. Obviously, one of the key asset classes that we like to focus on. I think it's pretty obvious, where office is right now, where retail is, and those kind of sectors that we don't really play in. But let's talk kind of specifically multifamily, and where do you think what is the core problem that the industry is really having right now, and do you see any potential upside?
Yeah, I think there's two things there's probably many more things than that at work here. But if you look at it from the standpoint of transaction volume and just kind of what's trading hands, there's kind of the four key sectors of office, retail, multifamily, and self-storage. Transaction volume across all of them are down anywhere between 15 and 25% year over year. We kind of know the thesis on office and COVID and what's kind of occurred there. And that's going to take some time to work through. But if you looked at, why these transactions are happening, one of the things we touched on last year when we did this, Dave, was we talked about the standoff between sellers and buyers, where sellers had just gone through 2021 and 2022, where the most transactions had ever taken place back-to-back years in our history. Obviously, when that happens, it's kind of natural for that to come down and maybe fade a little bit. And so that standoff still occurs kind of today, in that sellers saw all this furious action and very compressed cap rates and saw the value that was created. But as interest rates went up, they did not feel that discounting their specific property was in their interest and don't want to sell. That standoff kind of still occurs to this day. Where we are seeing the weakness of all four of those sectors happens to be multifamily. And multifamily is down 4%. It usually represents about 28 to 30% of all the transactions. It's at 24% now, but there are a tale of two stories within multifamily, where you're seeing the higher quality, the Class A's in great locations. The Southwest and the Southeast being the two prominent. You're still seeing a lot of good deal flow there and a lot of decent transactions. Where there is a struggle is really two things: either older vintages, things that were built in the 70s and 80s, not transacting. And secondly, when you see some of the multifamilies that were brought on in a syndication format, the general partners or operators that either didn't foresee the interest rate increases or didn't have the resources to react in front of it, those that brought assets to market with an uncapped variable interest rate is where the majority of the weakness is and will likely continue to be. Obviously, that's why Fed interest rates and rate cuts are important. As they cut, those debt costs then go down. But that's where I've seen kind of the two big problem sectors within multifamily, is that the older vintage and the uncapped interest rates.
Yeah. And how much of the, percentage wise, is that of the market? Do you really think, right? The people that took on, uncapped, leverage?
I would say at the very extreme end, it would be 20%. So not within the majority, but there are still a number of them out there. And as they work through, it's just part of a typical cycle. As that works through, there are people that some investments will go bust, but that will then help to reset pricing and cap rates for future transactions. So it's a healthy, natural process to go through, albeit uncomfortable and not pleasant, but we will come out better on the other side.
Yeah. Are you seeing any solutions out there for there? I've seen certain operators, do like kind of a pref equity type of offering, to bring in some additional debt. Any other, options that you're seeing?
I'd say that's far and away the most common one, Dave, is that, adding a pref equity group, doing a capital call is fairly inexpensive, but investors are somewhat wary on doing that. The pref equity piece has been a nice solution to help kind of weather the storm and obviously hopefully get interest rates back down to a manageable level. But it is an expensive form of capital, in that some of those pref equity groups are requiring double-digit preferred returns for a smaller contribution of capital. So not cheap, but it's better than locking in a loss and trying to get through to an easier economic environment. That's what I would say for probably 99% of the transactions. I came across one that was actually solving this by doing a ground lease in connection with extended financing. That was the first I had come across someone doing that. But it's an interesting way to try to solve an uncapped debt problem, is selling the ground and being released back to you, whether it be on a 50 or 99-year term. But that's an interesting one that I've seen.
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have, and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com.
Yeah. Yeah, for sure. Why don't we unpack capital calls, right? Because this could be new to some investors who haven't been investing too long or haven't kind of gone through any different cycles and everything. So, if an investor is facing a capital call, what are some of the considerations they should be thinking about? How should they really approach that?
I would say, in my, I've been through a capital call before myself. I think it really comes down to what is the source and kind of the use for the capital. And there's a couple things that we should all kind of pay attention to is what is the operator's business plan going forward? And so, okay, we had an original thesis. A capital call is here because one or a number of things may not have gone the way that we expected them to. If it is a strong asset, meaning you have good occupancy, you have good collections, and it's primarily a debt issue, that's a much more tolerable way to look at a capital call that is of strength and one to consider. Where we get a little bit more hesitant is if more capital being thrown at a problem but doesn't address either the debt or the occupancy or the quality of the asset. And that's where it's more of a judgment call. So I think it's about trusting the operator, understanding the business plan, and does it actually solve the underlying problems? And if the underlying problems are a poor management company or poor tenant base, those can be things that are yellow flags that maybe money may not solve that problem. But on a debt issue or a pure debt structure, if all else is working in that specific property, then a capital call probably makes sense to participate in. At the risk of, if you don't participate in that capital call, you in some cases will have potential for a loss. If you've never been through a capital call before, basically what happens is if you've contributed, let's say, $100,000 to a syndication, and the general partners need additional financing to solve whatever problem is being had, they'll go back to all of the original investors and ask you to contribute more capital for the sake of the project. It's generally an optional capital call, meaning you don't have to participate in it. If you don't participate in it, everybody who does participate and provide more money maintains their same equity position. For those that don't, you have a slight amount of dilution. I think the one thing that I always go back to when I'm talking with investors about this is you really do have to understand and pinpoint what the problem is and identify, does this money solve that problem? And then two, kind of the old Warren Buffett saying is, rule number one is don't lose money, and rule number two is don't forget rule number one. So, in doing that, don't try to chase good money after bad. If it's a bad outcome and a bad decision, albeit it's not pleasant, but let's not compound the problem.
Yeah. No, there's some really good considerations to really think about. And, it seems that the majority of these problems just really lie with these, unprecedented rise in interest rates and not only, how many rates happen, but at the speed of which they were doing it, because the underwriting in the industry, 5-10 years ago, I mean, that's how like 90% of the deals were all underwritten in that way. I mean, banks, right, have the biggest, they're the biggest shareholder in the deal. So, and they were underwriting the deal. But, like you said, I think a few of those things have led up to a little bit of a perfect storm in some of those troubled assets.
Absolutely. And I can see how, I think it was a tough problem that would have been somewhat simple to maybe miss or misdiagnose. When seeing inflation go to 9, I was caught a little off guard myself in that I didn't expect them to raise as fast and as high as they did. It turned out to be the fastest and highest rate cycle in history, using it to counteract the mistake that the Fed made in the prior cycle in saying that inflation was transitory. Missing that boat, I think those two things together are what caused them to go so far so fast and just try to counter-react to an earlier misjudgment on their behalf.
Yeah. So on the flip side, where do you see the opportunities in real estate, right? Are things, starting to turn around, or are you looking at, distressed assets that might be coming online, or what are your thoughts there?
Yeah, so I think it's going to take a little bit more time for some of the troubled assets to actually work their way through. If you think about how a bank does their underwriting, if you have something that's going into a distressed scenario, a bank will typically take that asset and place it in their special services group and begin negotiating with the owner of that property, which is a generally, call it a 6 to 9 month process. And so as they go through that, some of the distressed markets will come back online and be available for us as an opportunity. But in the interim, we're kind of working through. There are pockets of opportunity where I think as long as we stay at the higher quality and in the best demographics, there are still opportunities that are there. But I am looking forward to try to see some of the distressed opportunities from things that maybe weren't operated, or didn't have the right operator back behind it. I'm hoping to see some more of those in Q4 and rolling into 2025.
With respect to private credit, how are you seeing, that market hold up, right? With the, assets you've been involved with, do you see any risks, right, given the current economic environment, or do you see any opportunities?
I think it's probably one of the most talked about sectors of the year if you exclude AI. If you're kind of looking at alternative investing with the combination of bank lending still coming down, they're still dealing with some troubled assets on their books. It's a natural fit for some of the larger players, the Apollos and Blackstones of the world, to hop into private credit. I don't see any real issues that concern me today. When you look at credit swaps or high yield credit that's being traded, I don't see a whole lot of froth there. But as we get, it is becoming a more mature asset class. Private credit really wasn't always a big asset class, but obviously with the attention of the larger ones, we're starting to see more of it now. I think as we do that, it's going to continue to grow, but it will also continue to get more complex. And as it does, then the risks kind of begin to grow. I've seen some newer issuances of private credit in CLOs or collateralized loan obligations. As they get a little bit more exotic, it'll introduce some risk, but I think we're still in the early innings, and I still think it's a solid opportunity today. We obviously participate in that through our merchant cash advance credit fund, and I think it's performed exactly as we expected from start to finish, and hence the reason and the investor demand for launching a second iteration of that.
Do you think that there could be any risk, if there's, economic uncertainty, could, the default rate increase, right, with, certain businesses, right, having issues in terms of paying back their obligations?
Yes, and I think it's always a risk. Meaning it's never not a risk, especially in the space of private credit. And the reason for that is the only real reason private credit primarily exists, or the mass market is due to businesses who either can't qualify for bank loans, have had a bankruptcy or something in their past that they won't pass underwriting for. Businesses that don't have the time to wait, kind of 90 days for that bank approval process. And so when you're dealing with businesses that aren't of the highest credit quality, meaning like a publicly traded company with plenty of cash on the balance sheet, this is a little bit different. And so with a weaker economy, we do expect, higher default rates if that were to occur. I don't see that as of yet, but it is always a risk. But part of the reason that we participate in this space is because the return profile is such that we can absorb that risk without impacting investor losses. And so that is part of the reason for doing that, is having a high margin of error, because I realize that I'm going to make mistakes. We all are going to make mistakes when we're allocating capital. And we want to make sure there's enough margin of error to calculate for that which we just don't know, or some exogenous event that we haven't heard about yet.
Yeah, what do you think the biggest risks are there on private credit side with merchant advances?
Yeah, that is the tough one. There's really two risks from my standpoint. So one being a general wide economic deterioration. If we had to go through a kind of an 08, 09 financial crisis, that would be very impactful to the point that we would have to reassess if we're going to continue deploying capital. Barring that, we still have that margin of error, but I think if we have a general sustained economic weakness, the businesses are going to struggle to pay, which means some of our returns may be delayed. Some will have losses and we'll have to recoup through legal means. I think the bigger risk is overall interest rate and funding costs. These businesses have kind of cost of capital limitations. And I think the bigger overarching worry that causes me concern about investing just about everywhere would be our unsustainable fiscal position. Many have talked about this for years on end, but there is at some point going to become a day where we have to account for the amount of spending. And we're averaging about $1 trillion in deficit spending every 100 days, which sounds a little silly to say out loud, but at some point, I would think that there's a reckoning that could come there. If that happens and U.S. borrowing costs go up, that essentially trickles down through every business in our country and will have an impact on small and medium-sized businesses for certain.
Good, thanks. And then, what do you think about, from an energy standpoint at this point, right? Oil and gas, what are you seeing? I know you're talking to a lot of folks, attending a lot of events and getting some data points. What do you think in terms of that asset class right now?
Yeah, I think, when we highlighted some of the fiscal risks with some of our investors earlier in the year, part of the course of action was to add energy to their portfolio as an offset, both as an inflation hedge, but in the event some form of debt event on the federal level comes to fruition, then I would think oil is one that should be sustained and higher. We've talked about a couple of things as a theme over the last couple of years. One being OPEC and the voluntary cuts that they put in. They voluntarily removed 2.2 billion barrels of oil per day. We started the year at roughly $70 a barrel of oil, ran up to 85 in mid-April, and we've come back a little bit. We're sitting at about $78 today. But there's two things kind of holding up that price, and that's the OPEC cuts in the Strategic Petroleum Reserve. So as you may recall, the Biden administration chose to release oil from the Strategic Petroleum Reserve around the mid-year elections to help with consumer gas prices. And they talked a lot about, refilling the SPR, which they didn't actually do. We're starting to see some signs of that now. So we've now had 25 consecutive weeks of inventory builds in the SPR, albeit fairly slow, meaning we went from 340 million barrels to 370 million. You kind of have in the SPR a maximum drawdown of 4.4 million barrels per day. So that gives us about 84 days of supply today at a maximum drawdown. But when you compare that with the amount of oil that we use, just thinking of the U.S., we use on average 20 million barrels per day. So a lot slimmer of a margin should some geographical event occur, geopolitical risk or a war somewhere else breaking out, rather.
Yeah, interesting. I think definitely having that inflation hedge is, still remains quite strong and valid. And again, I always think about also the macroeconomic fundamentals and supply demand side, right, of certain assets, right? And this one continues to be strong. If you look at the outlook for really the next, 5 to 10 years, most people are quite bullish in terms of energy. I think from the ESG initiatives and from other things that are happening there, right, it's still going to require a ton, right, of petroleum reserves to be able to sustain the demand that we have, regardless of what it is, whether it's EVs or even, wind and solar, right? It still requires a lot of petroleum-based products to fulfill that energy, and our demand for energy just continually increasing.
Absolutely. And I think you're right from the standpoint of treating it as both an inflation hedge, but also having those underpinnings when you have, OPEC trying to, or I guess Saudi Arabia trying to diversify their country away from oil. That certainly plays into the OPEC's decision for doing so. but still see a healthy amount of demand. I think the one worry at the beginning of the year that it's still kind of playing out and it's to be resolved, but the strength of China after essentially reopening hasn't been as robust as expected. But there's a lot of things, kind of working at our back that support energy prices where they are today.
Yeah, so I think with respect to the energy transition, I think there's going to be some interesting opportunities around carbon capture and some of the renewables and opportunities there, clean tech. But to me, those all seem very early days in terms of from an investment perspective, which doesn't really, hit our strike zone in terms of, specific real assets demand, that you have right now. I see those kind of much more speculation or angel type investing in those initiatives. But we are watching those very closely because I do think that that energy transition is real, and there are going to be some really unique opportunities developing from that.
Absolutely. We are still in some of the early stages on carbon capture. I know Japan is working on a project to do carbon capture underground, where they essentially use a technology to pull it from their distillates and then store it back into the earth. But I think those are kind of niche areas which may have some opportunities. And I think you're right in that the transition of energy to more renewables is likely a trend that's going to continue. I've heard merits on both sides, but I think oil demand is still there, and it's going to be a while before we could ever transition fully away from that.
Awesome. Well, really appreciate your thoughts today, Jason. A lot of really good insights. I know it's really difficult for investors to make really good decisions. I would also just say, trust the resources of where you're getting information from, and try to get, great data points that you can use, that you can cross-reference, to make the best decisions on allocating your capital. Certainly reach out to us if you have any questions. We're happy to kind of help and give you, the best perspectives that we can. Any final closing thoughts from your end, Jason?
Excellent interview. You always ask great questions, Dave. I think we've covered most everything that we had set out to cover. I look forward to continually searching for those pockets of opportunity and hope to bring that to you guys as we come across them.
Awesome. All right. Thanks again. Talk to you guys next week.
Thanks for listening to this episode of Wealth Strategy Secrets. If you'd like to get a free copy of the book, go to holisticwealthstrategy.com. That's holisticwealthstrategy.com. If you'd like to learn more about upcoming opportunities at Pantheon, please visit pantheoninvest.com. That's pantheoninvest.com.